Hi, and welcome back again to Tim Bigham's Option and Volatility newsletter. We'll be taking a look today at a recent trade in Carvana, CVNA, where some very unusual, very short-term option buying spiked implied volatility, not only in the extremely short-term options, but across the term structure volatility, setting up ideally for a vol capture trade. So let's jump in and take a look. First of all, here's that enormous, very short-term volume. As you can see out there, you can see the volume on the call is just incredible, to say the least, right? These are 4 days until expiration. Obviously, we don't like to play it that risky with, trades on any stock, especially a stock like Carvana, which is prone occasionally to some, quick short squeezes. So it did bleed out all the way out until October. We elected to go to October, right, where we saw some volume as well, to take advantage of the implied volatility pop across the entire term structure volatility, but going out to October, where we have a little bit over 50 days to expiration, buffered the risk. Time does buffer risk. We prefer to be less risky rather than more risky, simply because over the long haul, I think that is prudent. Certainly 53 days isn't super short term. So let's take a look at the trade as we put it on here. So here is the day before that big volume, right, on Friday, August 25th. You can see implied volatility. Here's the trade structure we elected to use, selling the October 35 put, out of the money put in a decent way here, selling the 60 call out of the money call in a decent way as well, and looking to give ourselves plenty of latitude on both sides there. So you can see the day before that big call buying that we just saw in the September 1st, the 4-day options, right? The implied volatility on this was traded a little bit over 105, almost 106, right? The delta by selling this strangle, right, selling the 35 put, 60 call, you would have been about 3 deltas net long, so about as neutral as it can be, right? Selling a negative 27 delta here, selling a 24 delta here. The stock would have closed at 41.20, as you can see here, and that 35.60 sell strangle, right, priced about 5.64. Then let's fast forward to Monday, the day of that big volume that we saw in those short-term options, right? You can see the implied volatility now spiked to 109.5, so it popped over 3.5 vol points, simply because that big short-term call buying, right, bled through to everything out here. The delta now, because the stock was up 380, right, that delta has flipped from long 3 to negative 10, so short 10 delta, so slightly short. We went from slightly long to a little more slightly short, right? But really pretty much neutral here. The stock, this is when we did put the trade on, or at least alerted the trade. Stock was right around 45, so the stock did pop nicely up 380, right? But that 35.60 sell strangle now at 582, up almost 20 cents, up 18 cents, even though you're looking at 45, right? The 35 put is 10 points out of the money. The 60 call, this is the trade structure we use, right, is 15 points out of the money. Yet the put, which is closer to the money, right, it's 10 points out of the money, trading at a lower net delta, right, a negative 21 delta. That call trading at a 31 delta, even though it is 15 points out of the money. Further out of the money, but higher delta. Why? Because of high levels of implied volatility, and high levels of implied volatility that just got higher by 3.5 vol points. So this is not only a vol capture trade, it's a way to more safely short these, short squeeze kind of stocks. We did this many times before, back in meme mania a year and a half ago or so, selling way out of the money sell strangles that were ridiculously priced, able to wait basically a day and realize a nice profit on that, and giving a huge cushion on either side, because these huge moves of implied volatility really give you the ability to get well out of the money here and still capture some decent premium. You can see here again, calls that are 15 points out of the money, trading at a 31 delta, right, and puts that are only 10 points out of the money, right, 45 is the stock price. These are the 35 puts at a negative 21 delta, a lower net delta, right? So that's why this trade really looked good on both fronts, capturing the big vol pop of 3.5 vol points, right? But also to guardedly short Carvana, which had been on an absolute mission in a way that I think makes a lot of sense here. And also, very important to remember, the theta on this trade is negative 11, right? Negative 5 theta on the puts that sold, negative 6 theta on the calls. That is not inconsequential. So basically, every day that goes by, right, you're going to be picking up 11 cents profit on the trade. So the fact implied volatility is so high, right, gives a bigger theta as well. It gives you more time decay to capture by selling this, structure here, the 35 put and the 60 call. So let's take a look at the actual trades here. So here's the day, August 28th, it was of that big short term, the 4-day call buying, and some even, a week later, but certainly enormous short term call buying that spiked implied volatility. We were able to sell that sell strangle, the 35 put, the 60 call. Here is the trade done on the account. Here it is from time and sales that matches up, right? So we sold it at 585. The delta at the time we sold the trade, right, we would have been 12 deltas net short, right, selling a 32 delta, selling a negative 20 delta on the put, right? The implied volatility that we sold it at, the average of the put and the call IV, we sold it about 109.5, right? The stock was at 45.40 at the time. Then fast forward a week, right, and we see implied volatility finally starting to drop to a level that makes sense to cover here. So we see implied volatility now approaching 105, certainly under 106 here. So plus our delta, we're getting a little short here. We don't like to get too short or long, right? The stock did rally about 4.5 points, right? It went from 45.40 at trade inception to 49.85 when we covered the trade, right? So we were getting, a little bit worried about the delta. We do have delta tolerance bands. It was getting very close to where we would have had to bring up the strike on the short put, trim down the position, do something defensively, or luckily, because implied volatility caved, right, able to close it out for a nice gain here. So let's take a look at how we did. So the smooth delta, which is simply the average of the delta at inception, which was 12 deltas net short, right, selling a 32 delta on the call, selling a negative 20 delta on the put, would have put us 12 deltas net short. Then when we covered the trade, right, the call delta popped to 37, the put delta dropped to 13. We are 24 deltas net short when we cover, right? So the smooth delta, which is simply the average over the two, and it's the best guess on over that time frame what kind of the average delta would have been on the trade, right? So our smooth delta, 18 deltas net short, is roughly what we would have been pretty much short on the trade, with the stock moving up almost 4.5 points. Our expected loss from a delta perspective, right, we would have expected to lose about 80 cents, right? We're short 18 deltas, the stock goes up. If you're short and the stock goes up, you're going to lose money from a delta standpoint. So roughly about 80 cents would have been our expected delta loss. But remember, we have that theta, and when we are short options, right, we are positive theta. We collect that time decay, right? And remember, going back here, that theta was 11 cents a day, and since we held the trade for a week here, our expected theta gain, right, from time decay would have been 77 cents. So that almost virtually offset the delta loss, right? So overall, between the two, we would expect to lose about 3 cents by doing this sell strangle, right? Losing 80 cents from the delta side, right? Picking up 77 cents from the time decay side. However, our actual P&L, right, was 50 cents. We covered the trade at 535, as you can see here, right? Buying back the calls at 382, the puts at 153. And you can see the big reason on that 50-cent gain was this big drop in implied volatility from 109 and change to just under 106. So that IV reverted over 3 vol points, which allowed us to close out the trade, which should have been a small loser, right, into a very nice winner of 50 cents. Our actual vol capture, right, was 53 cents, which is the 50-cent gain on the trade, right? We sold it at 5.85, bought it at 5.35. So we realized 50-cent net gain on the trade for each contract sold, right? But we should have probably realized about a 3-cent loss if we had covered it in a similar fashion. But because of that big drop in vol, we avoided that 3-cent loss and actually made a 50-cent gain. So our vol capture edge was 53 cents. The loss we avoided of 3 cents and the actual gain that we did realize of 50 cents. So let's take a look at it from an actual, chart pictures worth 1,000 words here. So here's the implied volatility 60-day IV, which is roughly that October expiration, which has 50 some days to expiration, right? Here is the day we put the trade on. You can see how implied volatility, which started at 103, popped to almost 107 as we noted. Then when it reverted back down, right, that 3 and change IV reversion, right, we closed out the trade. So here it is in chart form, right? Here's the day we put it on up here. We like to sell the rip, right? So that was the highest level it got to, right? It could have gone higher, and we certainly would have been okay because, we wouldn't have probably gotten too exposed from a delta standpoint on this because we had such a big cushion on both sides, right? 15 points on the calls, 10 points on the puts, right? So we were able to sell the rip. And then when implied volatility reverted back down, right, we closed it on September 5th. We bought the dip here. So that, in essence, when you look at this chart, is what we look to capture day in and day out by doing this strategy, this vol capture trade. We look for unusual option activity that temporarily distorts the implied volatility surface. When it gets to an extreme, we look to sell it in a somewhat delta neutral fashion, selling puts and calls both, right, in a as close as you can get in neutral fashion, right? And then when IV reverts, we look to take it off and buy the dip and realize a gain. So hopefully explains again some of the thought process behind it, the actual mechanics of it, how you want to look at it. And these are actual trades. So this one, you can go back and take a look at the actual time and sales and see the actual trade. So until next time, as always, here's to good trading. Take care.